How many dividend stocks should you actually own? Too few, and one bad earnings report kills your whole portfolio. Too many, and you're probably spending too much time looking at companies, and you might as well have an ETF. Hello, my name is Jeff Wright. I'm president and founder of Fish Creek Capital here in Birmingham, Alabama, but we are able to help you virtually from anywhere in the country. We focus on dividend growth investing, so this is a topic we love. Let's get into it. The problem with too few companies. A lot of investors get excited about 5 or 6 companies they really believe in, and that's all they own. The problem is if one of those companies cuts its dividend or has a bad year, that's a huge chunk of your income, and it goes away overnight. You don't want to learn this the hard way. You don't want your retirement depending upon 2 or 3 companies making all the right decisions all the time. On the flip side, the problem with too many companies is, you'll see people with 150 or 200 individual stocks. That's what they'll recommend. And look, at that point, you're not really stock picking anymore. You can't possibly know how all 200 of those businesses make their money. You're just recreating an index fund, except you're paying more in trading costs, more in time, and more in taxes when you have to rebalance. It's not efficient at all. There are great Vanguard ETFs even if you're interested in that. The sweet spot is what we want to talk about next. So for you, most individual investors, building a dividend growth portfolio, which is what we're talking about here, should aim between 20 and 35 individual companies. That's enough to spread your risk across different sectors, utilities, consumer staples, financials, healthcare, industrials, even technology, without any single company being able to sink your income if something goes wrong. And it's few enough that you can actually follow the businesses you own, and you can also follow how much those businesses are actually growing their dividend, which is a key point that we focus on here at Fish Creek. You can read the earnings reports. You can understand what's happening. You don't have to gamble. You can actually understand the business, which is really what investing is, right? Here are 2 simple rules that I like to use. First, no single stock should be more than 5% of your total portfolio. That way, if one company cuts its dividend completely, you're not devastated. But that should not really happen. If you're reading the earnings reports and doing the things above that we talked about, you should know ahead of time if that is going to happen or not. Like in most cases, you're not always going to know, but you can often figure that out as far as a dividend being cut. But still, about 5% of your total portfolio on one single stock. Secondly, don't let one sector dominate your whole portfolio. If you're overweight in energy or overweight in tech, you're not really diversified. You're just spread, you have the same risk across just more ticker symbols, right? Or more individual companies in that sector. So make sure you do have good diversification from multiple sectors. So what we do here at Fish Creek, we typically build portfolios around 30 individual dividend growth companies, and we'll layer in a low-cost ETF where it makes sense, especially for smaller accounts that are still building up to full diversification. It gives you the best of both. Real ownership in businesses you understand and a safety net underneath it. So to sum it up, too few stocks and you're taking on risk you don't need. Too many and you might as well buy an index. Somewhere in the 20 to 35 range of individual companies with no position over 5% is the sweet spot for most people. We can help you figure that out here at Fish Creek Capital. So that's the call to action. If you want help figuring that out, and specifically with your portfolio and where that stands right now, if it's too concentrated, too spread out, or if it's just right, click the link below and let's talk. I would love to meet you. And also, if this was helpful, please like and follow along. I'll see you on the next one.